Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 29th of August. I'm Daniel Lam, your host for the podcast. Yesterday, we spoke about how the modestly hawkish stance from the Fed may limit the upside on US equities in the near term. However, the story is somewhat different for Japanese equities, so let us investigate today. Japan's outlook continues to be improving. Its economy is picking up, with growth surprises turning positive. While domestic demand has been a significant driver of Japan's current upturn, exports have performed better than other key Asian exporters, helped by an undervalued currency. Meanwhile, rising tourist arrivals has boosted services exports. Meanwhile, Japan's core inflation accelerated to 4.3% year-on-year in July. Facing rising inflation, the BOJ has started to unwind its ultra-loose monetary policy. As a result, Japanese bond yields surged to a 9-year high last week, but the BOJ stepped in to smoothen the rise. Now expect the BOJ to further widen its target yield band, currently at 1%, or end its yield curve control policy altogether over the next 6 to 12 months. However, do note that the Japanese yen remains very weak versus the US dollar. In fact, dollar yen has broken above the important resistance level at 146. Thus, while Japan monetary policy has begun to tighten compared to the US, it is still in a relative sweet spot. Thus, we continue to be overweight Japan equities. Year to date, amongst the DM in US dollar terms, Japanese equities have trailed only US equities. And Japanese equities are relatively inexpensive. So for example, the MSCI Japan Index is trading at 14 times 12-month forward earnings, and that's compared to 19 times for MSCI US Index. The Topix Index itself appears to have good support just above the 2,200 level. We expect Japanese companies to deliver positive earnings surprises, boost dividends, and sustain record share buybacks. A sharp gain in the Japanese yen, if the BOJ-led bond yields rise significantly, is a risk to this view, but taking FX unhedged equity exposure can help mitigate this. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.